Hello, this is Team Wiser here. We're doing a special video today to talk about the proposed tax changes that are getting a little more refined. I think it's safe to say that where the current administration campaigned on, we're pretty far from that. This is more of a Democrat committee tax proposal. I will say that this is not a final tax proposal whatsoever, but based on how power is divided currently, we could see a very similar variation to what we have here. So let's start just by summarizing what we know so far. One of the things I'm most concerned about has been capital gains. And right now, capital gains appears to be taxed around the 25% range.
Yeah, and that's an increase for the highest earners right now at 20%. There's still a 3.8% net investment income tax above that, but that's significantly lower than what was proposed. Originally, they were going to make it the same ordinary income tax rate. So that would have been putting the high income earners in the 40-something% bracket for capital gains taxation. So this is a better deal than originally proposed.
Another thing that we should focus on is income tax. We're looking right now at 39.6% would be the highest bracket, but it's moved down. So right now, I think up to $523,000 for single or $628,000 for married filing jointly was the top bracket. That's now moved down to $400,000 for single, $450,000 for married joint. That's a significant change.
That's one of the income brackets that's expected to be hit the hardest in this, as they've lowered those thresholds down to $450,000 on total income. That portion between those two ranges now are going to be hit the hardest in that tax bracket. So those are the tax filers that need to be paying attention and do the planning ahead of time if they can to be ready for this should this pass this coming session.
One thing I'll go back about capital gains on is they want it to be retroactive. So that's something that I don't know if that's ever been done before, where we've made changes for the current tax year, not just forecasting 2022. So all the other proposals are for 2022, but for capital gains, we're looking back. If you have to have a sale done by, I believe, September 13th.
Yeah, whenever this was proposed. So basically anything from here on out through the end of the year could still be taxed at that higher bracket, although it wouldn't have technically even been passed yet.
On the capital gains.
Correct.
Right. So they're trying to eliminate individuals, from utilizing the current tax code to take advantage of the lower tax bracket for the next period in time between now and the year end, should this proposed tax code pass in Congress.
So something we talk about here a lot is doing backdoor Roths and mega backdoor Roths. I find it very interesting that the administration wants to eliminate those. So basically, a backdoor Roth is when you contribute to an IRA with no tax deduction and then immediately convert it into a Roth IRA. You would do that in order to get your money to grow tax-free going forward. Right now, for people in the top income bracket, they would not be able to do Roth conversions or even mega backdoor. That's where you'd use your 401k to convert into a Roth. Right now, it looks like you wouldn't be able to not do that right away, but there's a 10-year window, basically encouraging taxpayers to convert to Roth accounts over the next 10 years.
Right. Pay the taxes now in the anticipation that there would be that increase down the road.
Correct. Doesn't affect too many people that we know, but if you had over $10 million in a retirement asset account, they're going to have a required minimum distribution of 50% and 100% above 10 million.
Right, so from 10 million to 20 million in a qualified retirement account, you're going to be taxed at 50%. You're required to withdraw 50% of that money. And then above 20%, 20 million, you have to withdraw 100% of that money. And you'll be taxed in that particular year. Well, they're saying they're giving people a break because if you're under age 59 and a half, you won't be assessed the 10% penalty.
Yeah,
okay.
That's, yeah. I hope that one doesn't stay, but it's really targeted, I think, to one individual person who is not friends of the administration. I think is
made some recent news over the last few months.
Yeah, absolutely. We can talk a little bit about grantor trust. Brad, do you want to touch on that and changes they're trying to make there?
Well, essentially, a grantor trust can be used by wealthy individuals as an estate planning tool, and it has certain provisions in it that allow you to accumulate money inside the trust and thereby passing it outside of your estate. But what they're doing now is they're reconsidering that aspect and saying that gains inside the trust must be taxed in the given year rather than being deferred to at passing through the estate plan. So defective grantor trusts are effectively being eliminated.
Another thing I wasn't happy about for our existing client base here, people who own businesses. So if you're an S corporation owner and your modified adjusted gross income is going to exceed $400,000 is for single or $500,000 for joint, you're going to be subject to additional 3.8% surtax on your income tax return. Again, it's the bill's really targeted between 400 and 500,000. The good news for retirees who aren't in that income bracket is that you really aren't affected that much. So that's good for most retirees, people who are already retired. People on the path to retirement, selling businesses, transferring assets, you're going to pay a significant more in tax through capital gains and through income tax.
And the estate tax exemption is being lowered.
Yes, this will affect a lot of families as well. Basically, they're cutting that by 50%. So right now, you have, give or take, $11 million per person as the death tax exclusion.
Right.
That's going to drop down to essentially about $6 million a piece. So it'd be $12 million. And when the good news, I guess, for some farmers was that there's some clawback for them because they're usually hit hardest by the estate planning.
It got significantly increased for farmers, and then certain family businesses increased from $750,000 back to the $11.7 million. So real property for families and family farms and businesses, it actually worked to their benefit for this tax code.
So again, this is all proposed, but in the event that this does pass, people with estate plans having estates greater than the $12 million at this point are going to need to go back to their estate planning attorney and review their plan relative to the new current taxes should these taxes pass, and redevelop a new estate plan for themselves.
Yeah, essentially estate planning, and then for business owners also your retirement planning, your retirement planning or income deferral, I should say.
Right.
There's solutions out there that you can, if you're right there on the cuff of $400,000, $500,000, there's solutions that you can do to get yourself below that limit while also saving for your future. And there's probably a lot of ways to get creative. Obviously, the $5 million and above level, your taxes are significantly increased. But if you have that kind of income, there are other things that you can do as well to hide a lot of that income legally from being taxed. For a lot of other people, you're going to see an expanded child tax credit extended in this proposed bill. Right now, it would go from $2,000 to $3,000, and eventually expanding it to $3,600 for children under the age of 6. It's a fully refundable tax credit, and they'll still do the monthly payment in advance, just like they're doing in 2021. I think that's all we got.
It's a broad, sweeping changes to our tax code, and it's based on creating a different type of revenue stream to the government in order to pay for government's programs and needs, going forward. But it says a lot about where Congress is thinking about what they want to accomplish. The CBO has looked at this and if it passes as is, would put the United States in the most progressive tax bracket in the world. They also did some additional studies, which I found interesting. The top 1% of the income taxpayers in the U.S. pay 40% of all the income taxes. That's $616 billion into the tax system, and yet they only earn 21%. So they earn 21, and pay 40%. Okay, so that's really twice their fair share, perhaps.
Yeah.
When you look at the bottom 50% of the taxpayers in the U.S., they earn about 11.6% of all the income and pay 2.9% of the income taxes. 6 in 10 people in the lower 50% of the income get more money from the government than they pay into the government. Okay? In the lowest quintile, it's actually a negative 10.9%, which means they receive 10.9% back, from the government, at any given time. So it's a sweeping, tax change. Taxes, pay for the things that we need. We'll see how this passes. There's still some debate in Congress whether or not this will pass in its entirety. So we'll just have to keep everyone informed.
All right, thanks, Brad Matthews, and we'll add Emily Fleming did a great job of taking all these notes and doing some pre-video research for us. So Team Wiser, good job. Thank you.